Hi, Bill Bodner, Mortgage Market Guide. Thanks for tuning in to our MMG Weekly Recap. So, three things we're thinking about that I would be sharing with clients as well as partners that provide some of the macro trend for interest rates and where things could go over the next, not just near term, but for the foreseeable future. And one is the Fed. And, we say don't fight the Fed. The Fed is purchasing $120 billion worth of treasuries and mortgage backed securities combined every month. And there are all signs now that even with, and by the way, they should be commended for not only stabilizing the mortgage-backed security market in the depths of COVID, but they also helped fuel this incredible rally in refinance activity and meeting the demand of the purchase side by just pinning long-term rates lower. There are signs now that if rates start to tick up, that they will do even more to pin down long-term rates by buying more bonds. So the Fed is there, and that's something we're thinking about. But what can cause rates to go higher? The next thing is stimulus. Another stimulus plan is coming. We're trying to get these targeted, quote unquote, stimulus package done or a skinny package done. As of this video right now, that's being poo-pooed. So it looks like there will be no big deal before the election. We hope that's not the case because we do see some industries and firms and many people in dire need, but that isn't happening yet. But come the election, and depending on where the House lands, will depend on the size and scope of this stimulus package. But one is coming. And with the stimulus package comes a few things. Number one, more supply. The bond market is already struggling with supply, so that puts pressure on bonds, number one. Number two, it's inflationary. We're seeing inflation expectations long-term start to rise. If inflation expectations start to rise, rates have to rise. That's another problem for bonds. The third piece is that it's stimulative. It's an aid to the economy. It's helping the economy grow and the recovery to come to fruition. Those three things are bad for bonds. So we have, the Fed helping, we have more stimulus kind of hurting. And then the third piece I'd be looking at is the technicals. And right now it's pretty darn clear. There are a couple levels that I would be looking at. 79 basis points on the 10-year note. We're beneath it now, and we remain beneath it. We've only closed above 79 basis points 4 times since really this entire COVID nightmare. And so seeing a move back into the 80s, so to speak, would be very bad because I believe it would also put a lot of pressure on mortgage-backed security prices to move lower and having home loan prices kind of creep higher. Technically, mortgage-backed securities, I'm looking at this 104.59. You could see clear support here. It was back in August, and it served as resistance going for months. So 104.59 on mortgage-backed securities at 2.5%, 79 basis points on the 10-year note. And those are the three things that we're looking at as we move in the next week. And next week, we have some reports on top of all this uncertainty, presidential election, mail-in voting, confirmation hearings. We have some big reports coming. We have CPI, so inflation data, as well as retail sales. So there's a lot to track. Hope this finds you well. Have yourself a great weekend. Be back at it soon. Bye for now.